Good day, everyone. You're welcome to this week's Business and Investment Tips program, a production of RCCG Christ Church Radio with Dr. Ayodeji Ebo, an investment professional. This week, the focus is on Treasury bills, a simple guide for new investors. Treasury bills, often called T-bills, are short-term investments issued by the Central Bank of Nigeria on behalf of the federal government. In simple terms, when you buy a Treasury bill, you're lending money to the federal government for a short period, and you get your money back with a return at maturity. The CBN also uses T-bills to manage liquidity in the economy. The CBN sells Treasury bills at bi-weekly primary market auctions through authorized dealers, mainly major banks, which submit bids on behalf of investors. Each bid states the amount of T-bills the investor wants to buy, subject to a minimum of 50 million naira, and the return the investor is willing to accept. The CBN aims to raise the required amount at the lowest possible return. Investors who do not indicate a specific return in their bids are prioritized when it's time for allotment, and they receive the return that clears the auction. In recent times, the Treasury bills primary market auction continues to attract strong interest, with rates closing at attractive levels. The 90-day, 182-day, and 364-day bills closed at 16.3%, 16.5%, and 17.3% respectively, translating to yields of about 16.8%, 17.8%, and 20.8%. The higher yield on the 364-day bill allows investors to lock in very high returns, especially as it is likely to be higher than both current and future short-term inflation. Looking ahead, the Q3 2026 NTB calendar also shows that Treasury bills remain an important borrowing tool for the government, with planned issuance of about 5.8 trillion naira against maturities of about 2.64 trillion naira. Most of the offer is concentrated in the 364 bill, which may help keep yields attractive for investors, especially if market liquidity becomes tight. As T-bills continue to attract investor attention, let us explain what they mean and how they work. Why do investors buy Treasury bills? First, they are considered low risk because they are backed by the federal government. Second, they are liquid, meaning they can be sold before maturity if you need cash, though the price may fluctuate with market rates. Third, they can be used as collateral for loans. Fourth, they usually offer better returns than a savings account. Finally, they are short-term investments with maturities of 91, 182, and 364 days, making them useful for short-term plans. However, investors should note that Treasury bills are now subject to a 10% withholding tax on the interest earned. This means your final return may be slightly lower than the quoted return. There are two main T-bills related instruments that investors hear about in Nigeria. The first is the Nigerian Treasury bills, or NT bills. These are used to raise funds for government spending. Individuals, companies, banks, pension funds, and foreign investors can buy NT bills in the primary or secondary market. The primary market is where the investors buy through auctions conducted by the CBN. The minimum amount for direct participation is usually 50 million naira. However, retail investors can buy smaller amounts in the secondary market through banks, stockbrokers, and investment platforms. Some platforms allow investments from as low as 100,000 naira. The second is open market operations, or OMO bills. These are mainly issued by the CBN to control liquidity in the financial system. OMO bills are mostly available to banks and foreign portfolio investors, so they are usually the main option for retail investors. How do Treasury bills work? Treasury bills do not pay interest upfront or monthly like the savings account or fixed deposit. Instead, they are sold at a discount and redeemed at full value at maturity. This means you pay less today and receive the full amount at the end of the tenure. The difference between what you paid and what you receive at maturity is your return. For example, if you buy a one-year Treasury bills with a face value of 1 million naira at 15%, you may pay about 850,000 naira today and receive 1 million naira at maturity. The difference of 150,000 naira is your return before tax and charges. This also explains the difference between interest rate and yield. The interest rate is used to calculate the discount. The yield is the actual return on the money you paid. In the example above, the yield is 150,000 naira divided by 850,000 naira, which is about 17.6%. This is why the yield is usually higher than the interest rate. For shorter tenors, the return is calculated based on the number of days. So a 90-day Treasury bill does not pay the full annual rate. It pays the portion that applies to 90 days. Treasury bills can be useful when you have money you need soon. For example, if your child's school fees are due in September, you can buy a Treasury bill that matures around September. That way, your money earns a return while you wait, and you may not need to sell before maturity. In summary, Treasury bills are suitable for investors with low risk appetite who want to preserve capital and earn better returns than a regular savings account. They are not meant to make you rich quickly, but they can help your money work better while you plan for short-term needs. Thank you for listening. Please join us same time next week for another exciting and insightful session. For questions, comments, and feedback, kindly forward to ayodeji@gmail.com or send an SMS to 070-8246-3747. Stay blessed and have a great week. Bye.